What's guiding your assessment of where we are?
So I'm looking at both inflation and productivity. And if you look at inflation, you're seeing that it's been pretty contained so far in the goods prices, which have been directly tariffed. And then you look at the other parts of inflation, you just don't see much of a run-up. So that's good news. And inflation expectations, what people expect, remain very well anchored. Look at productivity, and you see that productivity is rising, GDP growth is rising, while the labor market is slowing. So that tells me there's a little bit of that boost coming from firms looking to do more with less, but that's also causing a slowdown in the labor market. So the 50 basis point adjustment we've made has helped support the labor market, but still keeps policy restrictive so that we can put downward pressure on inflation.
President Daly, what are you looking at to determine whether it's the 1970s or the 1990s?
Well, I'm going to really look at things that improve productivity, to think about the 90s, and it's more than just the stock market valuations for AI companies. It really is about the companies out there who might be using AI, and then asking them, going directly to them and asking them, what's it doing for your bottom line, and how are you using it? And what we're hearing are pretty encouraging but very early signs. They see how it can help their bottom line, how it can improve their productivity, even how they can be supportive of their workers, give them more interesting work, take the less interesting work away. But they all tell us it's early days, so more to come on that. And then on the inflation part, are we in the 1970s, really asking employers and firms, what are you doing with prices? Are you thinking about raising your prices? How are you going to think about losing volumes if you do so in a slowing economy, especially for consumers, from the 50th percentile down? And putting those two things together, I think we'll get a lot of clarity about which direction we're heading. And with policy, been slightly adjusted, we are in a good place to continue to evaluate the information before we make any decisions. We can't know ex ante before the data come out and before we get that information really what we're facing. We just have to have an open mind about which one it could be, and maybe other periods of history I didn't even mention.
President Daly, how different would the neutral rate be if it were, say, more like the 1970s or more like the 1990s? Just how different would Fed policy be in response to one or the other paradigm?
Well, there's many nuanced ways it could affect the neutral rate, but I can back up from that and just ask what were the policy remedies. If you think we're about to have an inflation run-up, then we obviously would have to hold policy tighter for longer because we wouldn't want that to occur. Honestly, Americans have endured, already too much inflation, and we really need to get that back down to 2% to restore price stability as we've committed to. On the other side, if it's productivity, you would start seeing the economy able to run a little bit longer. Maybe if you go back to the debates of the 90s, we saw the labor market slow. Workers were insecure, but the labor market had unemployment that was fairly low, and many at the time were worried that could spur inflation. But Chairman Greenspan held on with his colleagues. They didn't raise rates, and what you saw was, the 90s, which was a booming time, and we ended around target inflation, and we had a productivity boom. So you're trying to balance those two things together, and it means not looking just at headline information, but getting below that information, talking to firms, talking to consumers, talking to workers, really on the ground work like we do at the reserve banks and other places. The Fed is built to do this on the ground work as well as look at the published data.
President Daly, reading the blog post this morning, it seems like you're leaning more toward the 1990s side of things than the 1970s. Is that right?
Well, right now, I'm in the West. I have the 9 states in the Western United States, and it's not just Silicon Valley that seems interested in AI. No matter who we talk to, whether they're, small businesses, medium or large businesses, manufacturing, tourism, et cetera, they're using AI in a way that they say is going to improve their productivity, and they're already seeing parts of it. So when I see that, I'm like, okay, we need to think about that. What really will spur this as an ongoing thing is if they start to change their business processes. So that's what I'm looking at. Now, that means, but I guess a different way to say that is we cannot take our eyes off inflation. Again, Americans have endured high inflation too long. That's our mandate. So while I'm looking for productivity gains and seeing if they're going to continue, I'm also keeping my eye completely focused on inflation to make sure that it doesn't pick up in a way that would suggest we need to do more or we need to hold longer.
President Daly, how would you respond to the criticism that the Federal Reserve as an institution has taken its eye off inflation, that inflation is closer to 3 than it is to 2, and the Fed's been cutting interest rates?
I don't think that if you unpack the inflation data, you really see signs of that. It's true that headline inflation is printing at that level, but you have to take apart that inflation and ask how much of it is the effect of tariffs passing through to goods prices that we expect to be a one-time price level adjustment and not a consistent run-up in inflation. And if you unpack the data, what you see is you don't see inflation running up in services or housing, and importantly, you don't see it spreading into inflation expectations that would be the thing that would continue to run up inflation going forward. We also see a labor market that's softening and wage growth that is moderating, so you're really not going to see a lot of pressure coming on the cost side of labor. So I put those things together, and we don't want to make the mistake of holding on too long for rates, only to find out we injure the economy.
President Daly, can we just pick up on the cost of labor? I think this is really important right now. Clearly, and it's hard to dispute this, it's in the data, we've had a massive step down in payrolls growth. What's behind that is a little bit more confusing. Is it demand? Is it cyclical? Is it structural? Is it something else like immigration? What's your tell right now? What can you point to that helps tell you it's one thing over the other?
Yes, you look at prices. In this case, the price of labor is wages. If it was simply about supply and firms were still scrambling to find workers to fill what was jobs that were supported by the previous immigrants, you would find wages going up as they bid for workers to try to fill those jobs. But that's actually not what you see. You see wage growth slowing, even in sectors where immigration played a larger role. And so that, to me, says it's a demand shock, a negative demand shock, along with just a coincidental negative supply shock. So you lost workers, but you lost jobs at the same time, or you had job growth slowing. And what we're seeing now is does that continue to net out, right? What if the supply of workers doesn't keep going down, but the demand for workers does? Well, then we'd end up with a rise in unemployment. So have to keep squarely focused on those types of things. We're definitely in a low hiring period, and interrogating that labor market, continuing to watch the information, see what firms do next. That's going to be the important part.
And it's something that a lot of people have said really is the K-shape, the idea that particularly on the lower end, you have not seen wages keep pace with the rest of the income spheres. I just wonder, though, how much we are seeing a massive amount of inflation in asset prices and how that feeds into what you're looking at, especially at a time that may rhyme with the 1990s, and we know it happened after the 1990s. How much do you weigh that? How much do you have to pay attention?
Well, one of the things that you do, so financial market conditions are one input into our decision making, one of many inputs. We have two goals: price stability, full employment. We're trying to think about what inputs affect those two variables, those two goals. But what I look at is, if you look under the valuations, people are really talking about one of two things. This is going to be a transformative technology. AI is going to change the world. It'll be like electricity or the steam engine. And then the people who are a little more skeptical are saying it's going to be a business as usual technology. Think of computers and the internet. The thing that's true about both of those is they're both productive. You get productivity from both of those. They both help with growth. They both help the pie in the U.S. expand. And so we're not talking about a bunch of ideas with no backing. We're talking about, equity investors, not highly leveraged, going in and making bets really on whether it's going to be transformative or business as usual. But everybody agrees on one thing: it will change productivity.
At the same time, President Daly, some people would suggest that, yes, you will see stocks continue to go up in the face of another rate cut. But at the same time, the transmission mechanism of the additional cuts are slower to take place. It's less efficient in terms of the pass-through, just based on how much lending there is, whether it's in the private lending sphere or beyond. How do you measure these things at a confusing moment?
Well, I guess this argument that we've somehow lost our power, monetary policy doesn't transmit, I simply don't see it in the information. If you go out and you look at what happened when inflation was running really, really high, we raised rates pretty aggressively, and mortgage interest rates rose rapidly, car loan rates rose rapidly, and the economy slowed, inflation came down. Right now, what I'm seeing is we adjust rates, mortgage interest rates come down, not one for one, that's not how it works. Usually it's less than one for one, but they come down. You see a little more activity in the housing market, you see a little more activity in the borrowing market more generally, and you see that dynamic work. So I guess the most important thing is just to remember that monetary monetary policy acts with a lag. And right now we're making decisions not just for what's going to happen next week, but what's going to happen in the next 6 months to a year. So that's how we have to think about it with our forecasts, and then how we adjust policy as those forecasts evolve.
How frustrating has it been not to get government data?
You know, I really want the information, the fullest amount of information we can possibly get. But one of the things that I think may be underestimated in public about what the Fed does is we're regularly relying on government-provided data. That's the gold standard of data in the world. We're also relying on private sector surveys, which have been collected for many, many years, and we can correlate them with the government-collected data over time and know exactly how they relate to one another. And then, of course, there's really no replacement, especially at inflection points in the economy, for talking to businesses, workers, communities, and consumers, asking people what they're really doing. And then I like to do this: go to the parking lots of your favorite retail stores and look at how many cars are in the parking lot and what people are buying. That tells you a lot. Airports are full, people are out there. You can go to a sporting event or a concert, see how many people are there. What you see is an economy that is slower than it was. Consumers that are not, they're more picky about what they spend on, but they're still out there participating in the economy, and that's how we get the information we need to make the right decisions that are according to our mandates, but mostly for the American people.
President Daly, you've been working with the Fed or on the Fed committee for a long, long time in these debates. Have you ever seen it more divided than it is right now on the FOMC?
Of course. I mean, if you look at the transcripts and the meeting minutes, and it's helpful, go back and look at the 1990s debates and go back and look at the commentary around the 1970s. It is a misnomer to think people always agree. The right way to think about it, in my judgment, this has been my experience, is that the debate we have, I wouldn't even call it division. I would call it differences of opinion that are really healthy in a debate about trying to make policy in an uncertain time with no truth. We don't have truth. We have forecasts. We have our best estimates. We have taking the evidence and then taking it again and looking through it with different lenses. I see that as a strength of the committee, a strength of the Federal Reserve, and importantly, is delivering the best possible decisions we can make. So I have seen this many times before, and I think it's always at inflection points that you see the broadest amount of disagreement, and it's exactly what I hope people would want from a committee making decisions on inflation and full employment. It really does help us make sure that we're doing the best we possibly can.
So you're happy to confirm on the record you have not seen Governor Myron and President Smith in a fight in the two-day meeting? Can we confirm that, President Daly, today? That hasn't happened.
You always try, and yet I'm not a rookie.
Mary Daly, thank you.